What if the biggest financial collapse of your lifetime isn't coming suddenly, but slowly, right in front of your eyes, while most people stay distracted, emotional, and unprepared? History shows that the greatest losses don't happen because people are poor or unlucky, but because they ignore clear warning signs. The patterns are repeating again, the cycle is entering its most dangerous phase, and by 2026, those who fail to understand what's unfolding will pay the highest price, not just with money, but with their future. Every economic system in history has moved in cycles, not straight lines. Growth creates confidence. Confidence creates borrowing. Borrowing creates excess, and excess eventually creates fragility. This is not theory. It is a repeated pattern observed across empires, currencies, and markets for centuries. What makes these cycles dangerous is that they feel safest right before they turn. Stability creates complacency, and complacency blinds people to structural weaknesses building beneath the surface. At this stage of the cycle, debt levels are no longer tools for growth, but crutches for survival. Governments rely on borrowing to maintain social stability. Corporations depend on cheap money to sustain profits, and individuals are encouraged to consume rather than produce. This creates an illusion of strength, while the foundation quietly weakens. When growth slows, debt does not. It accelerates pressure on the system, forcing artificial solutions that delay consequences rather than resolve them. Late-stage cycles are marked by widening inequality. Asset owners grow richer as prices inflate, while wage earners struggle to keep up with rising costs. This gap is not accidental. It is a mathematical outcome of how money flows through the system. Those closest to newly created money benefit first, while those further away absorb the cost through inflation. Over time, frustration builds, trust erodes, and social tension increases, adding another layer of instability to an already fragile structure. What makes this phase especially dangerous is widespread denial. Most people believe that past crashes were caused by obvious mistakes, greedy individuals, or rare events. In reality, they were caused by systems reaching their limits. When enough people assume the future will look like the recent past, risk concentrates. The longer stability lasts, the more people position themselves as if it will never end. That collective belief becomes the greatest vulnerability. As cycles approach their turning point, traditional indicators stop working the way people expect. Strong employment numbers coexist with declining purchasing power. Stock markets rise while real economic resilience weakens. Confidence is maintained through narratives rather than fundamentals. This disconnect confuses those who rely on headlines instead of structural analysis, causing them to underestimate how quickly conditions can change once momentum reverses. When the shift begins, it rarely announces itself clearly. It starts quietly through tightening liquidity, declining trust, and subtle changes in behavior. Credit becomes harder to access. Volatility increases. Policies become reactive rather than strategic. Those who wait for undeniable proof are already late, because markets and systems move faster than public awareness. By the time the cycle is obvious, wealth transfer is already underway. The most consistent mistake people make at this stage is assuming that institutions will shield them from systemic risk. History shows that institutions prioritize survival of the system, not preservation of individual wealth. Rules change, incentives shift, and safeguards fail when pressure intensifies. Those who outsource responsibility for their financial future to external systems lose flexibility precisely when flexibility matters most. Understanding where we are in the cycle is not about predicting exact dates or events. It is about recognizing probability. Late-stage cycles do not guarantee immediate collapse, but they guarantee increased risk and reduced margin for error. Small mistakes become costly. Leverage becomes dangerous. Passive strategies stop working as expected. This is when discipline, diversification, and adaptability become more valuable than optimism. The end of a cycle does not mean the end of opportunity. It means the end of assumptions that no longer match reality. Those who acknowledge this early gain the ability to reposition, while those who deny it are forced to react under pressure. Awareness creates choice. Denial removes it. The cycle does not care about beliefs, opinions, or confidence. It moves according to structural forces that have repeated long before this generation and will repeat long after it. Debt rarely looks dangerous at the beginning. It presents itself as opportunity, convenience, and progress. Borrowing fuels expansion, accelerates growth, and creates the feeling that limits no longer exist. When money is cheap and easily available, debt becomes normalized across every level of the economy. Governments increase spending without raising taxes. Corporations leverage balance sheets to boost returns, and individuals are encouraged to finance lifestyles rather than build savings. This early phase feels productive, efficient, and modern. Over time, the purpose of debt shifts. Instead of generating future growth, it begins to sustain the present. Borrowing is no longer used to build productive capacity, but to prevent slowdown. This is the moment when debt stops being a tool and becomes a dependency. Interest obligations rise, margins shrink, and the system requires constant expansion just to remain stable. Growth becomes mandatory rather than optional, creating fragility beneath the appearance of strength. As debt levels rise, the ability to repay becomes increasingly unrealistic. When repayment threatens stability, the solution is rarely discipline. It is dilution. Money is created to service existing obligations, extending timelines while weakening value. This process is subtle and gradual, which is why it goes unnoticed by most people. Prices rise unevenly, assets inflate faster than wages, and purchasing power erodes quietly rather than collapsing all at once. This erosion impacts different groups in different ways. Those who hold assets benefit from inflation as values rise. Those who rely on fixed incomes or savings experience decline as their money buys less each year. The system rewards leverage and punishes patience. Saving becomes risky, while borrowing appears rational. This inversion of incentives encourages behavior that deepens instability and increases long-term vulnerability. Debt also reshapes behavior. Governments delay hard decisions to avoid social unrest. Corporations prioritize short-term performance to satisfy markets. Individuals postpone responsibility, assuming future income will solve present obligations. These choices compound across the system, reducing resilience. When shocks occur, there is little buffer left. Flexibility disappears precisely when adaptability is required. One of the most dangerous aspects of excessive debt is the illusion of control. Central authorities attempt to manage outcomes through interest rates, liquidity injections, and policy adjustments. These tools can influence timing but not eliminate consequences. Each intervention increases scale and complexity, making future corrections more disruptive. Stability becomes increasingly artificial, sustained by confidence rather than fundamentals. For individuals, debt exposure determines vulnerability. High leverage limits choices. Rising costs increase stress. Income disruptions become catastrophic rather than manageable. While debt can amplify gains in favorable conditions, it magnifies losses when conditions change. Most people underestimate this asymmetry, focusing on short-term comfort while ignoring long-term risk. Real wealth is not measured by access to credit, but by independence from it. Assets that produce value, skills that remain relevant, and systems that reduce reliance on fragile structures create resilience. Understanding debt is not about avoiding it entirely, but about recognizing its role within the cycle. When debt dominates the system, preservation becomes more important than expansion. Control shifts away from borrowers and toward those who can operate without constant leverage. The silent nature of debt destruction is what makes it dangerous. There is no single moment of collapse. There is a slow transfer of value, a gradual narrowing of options, and an increasing dependence on systems that cannot sustain themselves indefinitely. By the time the damage becomes obvious, choices have already been made, positions are locked in, and escape becomes difficult. Financial failure is rarely caused by a lack of information. In the modern world, data is abundant, education is accessible, and examples of success are visible everywhere. Yet despite this, most people remain stuck in the same financial position year after year. The reason is not intelligence, but emotional behavior. Decisions driven by fear, greed, comfort, and social pressure consistently override logic, especially during moments that matter most. Fear is the strongest force in markets and in life. When uncertainty rises, fear pushes people towards safety at exactly the wrong time. Assets are sold when prices are already falling. Opportunities are abandoned when risk feels highest, and long-term plans are sacrificed for short-term relief. This reaction feels rational in the moment because the brain prioritizes survival over strategy. However, repeated across millions of individuals, fear-driven decisions create collective losses. Greed operates on the opposite end of the cycle but produces the same outcome. When prices rise and success stories dominate conversation, people feel pressure to participate. The fear of missing out replaces caution. Risk is ignored, leverage increases, and discipline fades. Decisions are justified emotionally, not logically. By the time confidence peaks, upside is limited and downside is extreme. Those who enter late are not participating in opportunity. They are absorbing risk transferred from earlier participants. Comfort is a quieter but equally destructive emotion. Stability creates routines, and routines create resistance to change. When income feels predictable and systems appear functional, preparation feels unnecessary. Learning is postponed, diversification is delayed, and dependency deepens. Comfort discourages action until action is no longer optional. When disruption arrives, those who waited for certainty find themselves reacting instead of positioning. Social validation amplifies these emotional traps. People take cues from the behavior of others, assuming safety in numbers. When everyone is optimistic, skepticism feels lonely. When everyone is fearful, confidence feels reckless. This herd behavior reinforces cycles and increases volatility. Acting independently requires emotional strength, not just knowledge. The ability to stand apart from the crowd is rare because it demands tolerance for temporary discomfort and uncertainty. Another emotional barrier is identity. Many people tie their self-worth to past decisions, beliefs, or roles. Admitting that conditions have changed feels like admitting failure. This attachment causes people to defend outdated strategies rather than adapt. Markets and systems do not reward loyalty to old narratives. They reward responsiveness to current reality. Emotional attachment to identity slows adaptation and increases losses. Discipline is the counterforce to emotion, but discipline is uncomfortable. It requires delaying gratification, accepting uncertainty, and making decisions without emotional confirmation. It means preparing during calm periods and acting decisively during chaos. Most people prefer reassurance over responsibility, even when reassurance is false. This preference keeps them trapped in reactive patterns. Those who succeed consistently develop emotional distance from outcomes. They focus on probabilities rather than predictions, processes rather than excitement, and resilience rather than perfection. They accept that discomfort is part of growth and volatility is part of progress. Instead of trying to eliminate fear, they learn to operate despite it. Emotional mastery does not mean ignoring feelings. It means recognizing them without allowing them to control decisions. Awareness creates choice. When fear, greed, or comfort arise, disciplined individuals pause, reassess, and act based on structure rather than impulse. This ability compounds over time, separating those who remain stuck from those who adapt and move forward as conditions change. Crisis is often viewed as destruction, but in reality it is a process of reallocation. Systems break down not to eliminate value, but to redistribute it. Every major financial, political, or social crisis in history has shifted power, wealth, and influence from one group to another. The difference between those who lose and those who gain is not luck, but positioning before the disruption occurs. Crisis rewards preparation and punishes dependence on stability. When systems operate smoothly, inefficiencies remain hidden. Weak businesses survive on cheap credit, poor decisions are masked by growth, and structural problems are ignored. Crisis exposes these weaknesses all at once. Capital flees from fragile structures and flows toward resilience. Assets are repriced based on reality rather than optimism. What once seemed permanent is suddenly questioned, and what was overlooked becomes valuable. Most people experience crisis defensively. Their focus narrows to preservation of what they have, even if what they have is already losing value. Fear limits perspective. Short-term survival becomes the priority, and long-term opportunity disappears from view. This reaction is understandable, but it is also why wealth concentrates during downturns. While the majority retreats, a small group advances. Opportunity in crisis does not mean reckless risk-taking. It means understanding asymmetry. When prices fall faster than intrinsic value, risk decreases while potential reward increases. However, acting on this requires liquidity, confidence, and patience. Those who enter crisis overextended or emotionally exhausted are unable to act, even when opportunities are obvious. Preparation determines participation. Crises also reshape labor and skills. Entire industries contract while others emerge. Roles that once provided security become obsolete, while new capabilities become essential. Individuals who invest in adaptable skills and continuous learning gain leverage. Those who rely on static roles or outdated expertise experience decline. Opportunity is not limited to financial assets. It exists in positioning oneself where demand will grow as systems reset. Another overlooked opportunity during crisis is negotiation power. When demand weakens, leverage shifts toward those with optionality. Terms improve, access expands, and competition decreases. This applies to investments, employment, partnerships, and acquisitions. Those who can move without urgency can dictate conditions, while those under pressure accept unfavorable terms simply to maintain stability. Crisis also accelerates innovation. Constraints force creativity. Solutions that were previously resisted become necessary. New models replace inefficient ones, often permanently. Those who recognize which changes are temporary and which are structural can align themselves early. Resistance to change is costly during these periods, while adaptability is rewarded disproportionately. Emotionally, crisis strips away illusions. Confidence based on narrative collapses, revealing the difference between perceived strength and actual resilience. This clarity is uncomfortable but